All right, quick legal disclaimer before we dive in. This is for educational purposes only. It's not financial advice. Every investment carries risk. You know the drill. Today, we are mapping a massive tectonic shift in the market. This is one of the most significant, most overlooked asymmetric trades I've seen in a long time. Let's get right to it. Hit the like button, subscribe to the channel, and comment your top ticker right now. Look, retail is busy trading AI software, completely obsessed with the application layer. But Wall Street, they know the servers are literally melting. And while everyone's distracted, private equity is making a massive play. They are quietly hoarding groundwater rights to weaponize what we call synthetic scarcity. So today, we expose how institutions are front-running the end of free water and buying the ultimate physical choke point. This is where the real money is flowing. And listen, this isn't some wild theory. The footprint is already in the data. You just have to know where to look. So let's follow the institutional capital flow. Okay, look at your screen. What you're seeing here is absolutely critical. We've mapped the massive dark pool accumulation on Ecolab, that's ticker $ECL. See how it spikes in perfect sync with the demand for data center liquid cooling? That isn't retail buying. That's the big money, the quiet money, moving in. And the technicals confirm it. On ECL, you've got textbook view app absorption. That's institutions soaking up shares like a sponge. Then you switch to American Waterworks, AWK. You're seeing a classic RSI/MACD divergence. You know what that means? Bullish momentum is coiling up. And get this, the options market is screaming for a move, with an IV rank at 86%. The whole setup is a powder keg. Here's the physical reality that nobody can argue with. You cannot air cool an AI rack that's pulling over 100 kilowatts. It's just a law of physics. A big data center needs up to 5 million gallons of water a day. So where do they get it? They go to the monopolies. They go to AWK, the biggest player in the game, who's dropping $2 billion a year on infrastructure, and they go to ECL for their cooling as a service. It's a closed system. So let me put this in plain English for you. Wall Street algorithms know you cannot air cool a 132 kilowatt AI rack. They're using retail ignorance as liquidity to quietly hoard the water purification monopolies that tech giants will be mathematically forced to pay premiums for. It's not a prediction, it's an inevitability. Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. Okay, every solid trade thesis has to account for the alternatives, so let's game this out. The bull, the bear, and the black swan. The bull case is pretty straightforward. It's a perfect storm. Regional droughts get worse just as AI expansion goes vertical. It creates a supply-demand shock that sends proxies like AWK and ECL into parabolic price discovery. The hyperscalers will pay anything to stay online. Now the bear case, some kind of macro shock hits, a deep recession, and the tech giants have to pause their CapEx spend. The narrative flips, and these water stocks get dragged down to major support levels. Honestly, that just becomes another accumulation zone for anyone with a long enough timeline. And then you've got the black swan, the real tail risk. The US government steps in, declares water a matter of national security, and nationalizes all water rights. Boom. The entire private equity thesis gets wiped out. Overnight. It's low probability, but you cannot ignore it. Which brings us to the most important part of this whole thing. Your risk protocol. Capital defense is non-negotiable, period. So here's the protocol. 3 rules. First, you defend the baseline. You deploy OTO brackets on all entries. Define your risk before you even get in. Second, you lock in your gains. Use a 2.5x ATR-based trailing stop. It's mechanical, it's emotionless, it protects your profits. And third, you avoid weakness. You absolutely reject buying any asset trading below its 200-day moving average. No exceptions. And let's be crystal clear about that last rule. The 200-day moving average is your line in the sand. It is the baseline for capital defense. If you're trading below it, you are fighting the primary institutional trend. We don't do that. So when you put it all together, the physical constraints of AI, the capital flows, the monopolistic positioning, you get the synthetic scarcity trade. This is what a true asymmetric bet looks like. You know, the CEO of Water Asset Management put it perfectly. He said, water is the scarce resource that will define the 21st century, much like plentiful oil defined the last century. They're not just buying a commodity, they are buying the choke point. So I'll leave you with this question. As data centers literally become a new utility, just like the power grid, does that make water the ultimate asymmetric bet? Think about it.
If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on synthetic scarcity and the tickers mentioned, ECL, AWK.